realizes things. But let me bring on board Matt Orton of Raymond James Investment Management to give us his take. Matt, you heard Jensen. It's a new world, and it continues to accelerate this entire trend.
Hey, good morning, Hershon. That's absolutely right. I listened to the call this afternoon, and it was a great call. The results were very, very good for Nvidia. And I think what it provides investors is confidence that not only will Nvidia continue to beat expectations going forward, but most importantly, that there's constraints on demand because there's so much need for all of these chips. And so when you look at the reaction to Nvidia, it's encouraging that the stock is actually up. Nvidia tends to trade down, or at least it has over the past few earnings reports after good numbers. So I think that's a testament to just how strong these results are. But most importantly, for me as an investor as well, is looking downstream. You know, you heard a lot just now about the degree of the bottlenecks that still exist in able to deliver a lot of these GPUs. And so for me, following the AI CapEx beneficiaries, following the inputs that NVIDIA needs to deliver these GPUs, which leads me directly to memory, which leads me to optics, those are the places where there's still significant challenges and where there's still good investment opportunities, because a lot of these stocks have traded down over the past month and a half.
Matt, how do you look at the numbers coming out from China as well? The production numbers are a little lower, 7-month low there. Bank of Korea also raising interest rates for the second consecutive time. Is that something which is going to be a little bit of a dampener for Asian markets?
So, Sajid, I think Bank of Korea was widely expected with their interest rate moves. I think China is just in this malaise right now, and I think China is straddling challenges with respect to trying to spur domestic consumption versus managing a massive build out for artificial intelligence, a lot of which is being funded by the state government and state banks. And so it's challenging to walk and manage that line. So it's tough to read too much into the Chinese data, except I believe this is probably the worst of what we're going to see. I expect that demand, consumer-based demand in China, is probably going to inflect higher in the back half of this year, at least in Q3 and into Q4. So I'm actually a little bit more optimistic on the margin with respect to China. But when I look at Asia and the investment opportunities across emerging market Asia, it's still, to me, sits squarely in the AI CapEx beneficiaries, so Korea, Taiwan, and also then trying to complement investor portfolios with countries such as India that are very lowly correlated to US and developed global markets, as well as areas like Latin America that provide exposure to raw materials, which is also a key bottleneck, not just of artificial intelligence, but on the defense side, and critical mineral supplies and reserves that countries are trying to build out going forward. So there's still a lot of areas of opportunity across the EM complex right now.
And how do you look at the US 10-year yield as well? It's cooled off a bit from its top, but you still have a fiscal issue which is there.
Yeah, with the fiscal issues there, the fiscal issue's always been there. And what I tell clients is that the fiscal issue is there across all other alternatives to US Treasury. So for better or worse, I argue that the US Treasury benefits from the fact that there literally is no alternative with respect to depth of liquidity, ease of trading. And so while the deficit is a long-term structural problem, it's an issue for everybody. Doesn't mean that we should not bear it in mind. I think the market has overreacted to what Treasury Secretary Bessent has done. I think he's provided a little bit of just signal with respect to the fact that the government can and will step in if bond vigilantes actually do come to the market. But I would actually argue that the 30-year yield has been in a pretty good range over the past 10, 12 months or so, that we haven't really seen a significant deviation. So while we might be at the upper end of that range right now, nothing stands out to me as being too concerning. And I think we have Chair Warsh speaking at Jackson Hole on Friday morning in the US. I think that will set the tone with respect to shorter dated yields. But I continue to believe that the market is overpricing Fed rate hikes. I do not think that the Fed is going to hike rates this year. And while the core PCE data that we got today came in a little bit hotter than expected, there's absolutely no ammunition in that data that says that we imminently need to hike interest rates. So I continue to believe we're going to get NFP next week. We're going to get another CPI report before the September FOMC. And I think there will continue to see the picture of sticky but not out of control inflation.
Matt, therefore you're long on bonds, very clearly, on the US 10-year, is what I'm assuming, or even the US 30-year for that matter, at least on the long end.
Yeah, Harsh, I really, while I have conviction in this trade, I certainly would be looking to very tactically add duration. So I think after we heard Besant speak, I think you can certainly add a little bit of duration here, but it's not to say we're not going to have fits and starts. I would be aggressive in adding duration if the 10-year yield starts to approach 5%. Where we stand right now, could it come down a little bit? Yeah, maybe not. I think shorter duration buying 2-year yields, I think maybe makes the most sense right now, because that's where I think the biggest mispricing exists within fixed income is that we're still pricing in 30-40% rate hikes coming in September, which I just think is way too aggressive.
All right, Matt, thank you so much for joining us and giving us that perspective. Wonderful having you. Have a great evening.
You too. Thanks.